All right, good morning, everybody, from beautiful Southwest Colorado. Sunday, got a beautiful day here and a great week on the market ahead of us. Going to be doing a little introductory series here on charting, technical charting properties. We're going to be beginning very basic here in this video, very short, but just talking about candlesticks and support and resistance. To chart price movement on my charts, I use candlestick patterns. These are Japanese candlestick patterns, or Japanese candlesticks per se. This is a daily chart that we're looking at, where each of these candlesticks represents 1 day of price movement. So each of these is 1 day, whether it's a red or a green. If it's a red candle, that means it opened higher than it closed. It closed lower than it opened. If it's a green candle, it means it opened lower than it closed, or it gained during the day. So every candle has 4 points to it of data. Let's take a green candle first. Let me zoom in here. On a green candle, you're going to have the open, the close, the high, and the low. The high and the low make these tails, and the real body is the open and the close. Now here on the red candle, it's just the opposite. It opened higher than it closed, so it closed lower. This is the real body, the opening, the close, the low, and then the high would be the top. Okay? Now, what we want to look for is at any stock that we look at, we want to be looking for areas of support and resistance. Now, what does that mean, support and resistance? Going over here to the left of this screen, where we start to see support and resistance forming, support is this area in here, around 676. It's this area where, as this price is falling down, it tends to be bought up. People think it's a good deal at that price. The price is below the value, and it moves up. And what you'll see is that when it moves up and it comes all the way back down months later to this support level again. And then it moves up. This top line I have is a resistance line, depending on where you are in time on this. Basically, support, once the price falls below a support line, it becomes a resistance line. So once this big price movement through here, late April in through basically till June, this came below, this support broke support, it's called. It came below this support line and came down. And then it comes up, and now you'll see this acting resistance. The price comes up, it hits its head around 676, and it sells off, and it comes back down. It works its way back up, it hits its head, and it sells off. Now it pierced it here on a day. There just wasn't enough momentum to get through until it finally got through. Now we see what was resistance is now support. And at this point, we start moving into this channeled area here. Now this brings me to why we want our support and resistance always popped. And now there's not just 2 lines. I usually have 4, 5, sometimes 8 lines of support and resistance. They're basically price pivot points. I have those on my charts at all times, on charts that I trade. From here, we would be putting in another, basically a support line right through here. You see it was resistance. Now it's finding support in here. And there's some resistance in here. But let's look down here at this channel in here. The reason why these are important is because we can buy off support and know that we have a pretty good chance of selling into this resistance, and that gives us a fairly good gain. What it does also is it maximizes our risk and maximizes our reward, thank you, and minimizes our risk. So we could, if this goes against where we go in, if we're looking to buy here around 676 around support, and then swing this for 3-4 days, for a good, 50, 75 cent a share profit, we know that we can sell this if it breaks the support line very close to it. Maybe 3, 5, 6 cents underneath that support line in here. We're going to sell that if it goes against us. So we maybe have like, say, 5 cents of risk here and about 50 to 75 cents of reward in here. And then we sell this. This comes back down and we buy this again off support and we sell this again. And this is how we compound our wealth. And we do this much faster than if we had just bought and held the same stock. We would have bought and held it for 2 months in here. And in here, it's just about even from where we bought it. And we just sat on this money. Our broker made money, having our money in their account. And that's about it. And so, but we were able to buy and sell this a few times in this channel. And then as this broke resistance here, this is another good breakout play. Now we're in a consolidation period, and here's we're moving back to this yellow line, which is the 20 moving average. We'll talk about in another episode coming up. So that's a very quick intro to support and resistance. In the future, you're going to see a lot of stocks go on my charts. In no way, shape, or form are any of them a buy or sell recommendation. I want you to know that there is no such thing as a good stock pick. There was no such thing as a good stock. There is only such thing as a good stock trader. And that's my goal of this series, is to help make you a good active trader. Now, in the next few episodes, we will be talking about different types of support, whether it's support off of moving averages, support off of trend line, support off of Fibonacci retracement plays. Those will be some of the things we'll be talking about in the next few episodes. Thanks for staying tuned, and glad you joined me today. Thank you.